Welcome to the Retirement Services Division's presentation, which discusses how average salary is calculated for use in your monetary retirement benefit. Before we get started, a quick disclaimer. While the presentation is designed to answer most of the questions we have on this retirement topic, it is important to remember that we do not cover every tiny detail. In the unlikely event information in this presentation conflicts, the applicable retirement statutes, regulations, and decided cases that construe them are all the true governing law. In this presentation, we will discuss the different factors used in calculating retirement benefits. For most employees, there are three important factors used in the calculation of a member's benefit, and we have a video presentation on each of these topics. As I mentioned earlier, in this presentation, we will discuss how we calculate your average salary. To begin a calculation, we research either your 3 or 5 highest 12 consecutive months of earnings. With a few exceptions, almost every dollar you've earned as a member of SERS is used in the calculation of your earnings. If you were hired before July 1st of 2011, your 3 highest earning years are used to calculate your average salary. If you were hired after July 1st of 2011, your 5 highest earning years are used. If you are Tier 4, please refer to your summary plan description for additional rules on how your average salary is calculated. Each 12-month period used does not have to be a calendar year. For example, it does not have to be January 1st through December 31st. Each of the 12-month periods do not have to be consecutive. For example, if we use April 1st through March 31st, additional years would not be limited to the continuation of the April 1st through March 31st pattern. It also does not have to be your last years of employment if you had hired 12-month periods in the past. We are looking for the 3 or 5 highest blocks of 12-month periods throughout your career for this calculation. The earnings for any unpaid leave, whether it be furlough days, voluntary leave, or simply unpaid leave, that is less than 90 days in length, will be inflated back up to what they would have been if you had not been unpaid during that pay period. This also includes part-time, which is treated similarly. If you still receive longevity payments, which are paid in April and October, you will get a prorated longevity for the month of your retirement. This prorated longevity is included in the calculation of average salary. Lastly, when you retire, you will be paid the balance of any qualifying accrued vacation time. While it will not be included as a lump sum payment in your average salary, it is possible a small adjustment will be made to your average salary. We will discuss this a little later. There are some limitations that apply to average salary. We'll be discussing those in the next few slides. They are the 130% cap and the 150% cap. It is also important to note that we do not use Tier 4 members overtime the same way that we use non-Tier 4 members. Please refer to the Tier 4 summary plan description for more details. Finally, the IRS also has a limit on the amount of compensation we can use for the average salary for high-wage earners. This does not apply to many state employees. For example, the IRS compensation limit for 2022 was $305,000. For the 130% cap, generally speaking, the most common instances when the cap is applied is for members that had a large promotion or started working a secondary employment with the state. The calculation of your average salary limits each year to no more than 130% of the average earnings from the 2 preceding years. Mandatory overtime is not subject to the 130% cap. If a year is capped, it remains capped when we use it to measure to see if a subsequent year is also capped. Please note that any mandatory overtime during the capped year must be added back to review for the 150% cap. The 150% cap was created as a result of bargaining between CBAC and the state in 2011. It applies to earnings from July 1st, 2014 forward. This cap is applied the same as the 130% cap, except this time mandatory overtime is subject to the 150% cap. When you retire, you may be paid some of the accrued time you have left on the books. Vacation payouts are paid to the employee as a lump sum based on the accrual rate and bargaining unit limitations at the time of retirement. This payout is not lumped into your average salary since it represents time for service credit. Since vacation time counts as service credit and the average salary is limited to no more than 3 or 5 years of total earnings, any accrued vacation time added to the average salary would be adding additional service credit to the benefit calculation. There are scenarios where the payment could make a small impact to your calculation. Every day of accrued vacation time paid upon separation is another day included in the calculation of your total service credit. We like to consider vacation time a win-win-win. Win, you get paid for it, cash in your pocket. Win, you get additional service credit. And win, it might make a small increase to your pension. Please take a moment after the slide to review 2 examples of how the vacation replacement mechanism is applied. Though some union members' comp time is use it or lose it, there is no payout at termination. There are some unions or jobs that do allow for a payout of this accrued time at termination. Please review your union handbook or check with your agency payroll. If paid, the comp time will be used for calculation purposes at the time it was paid. In 24-hour facilities, we have found that members who work on holidays also have a special holiday time and/or TOIL days that they accrue. If you have questions on your payouts, see your agency payroll. For retirement purposes, we follow what you were actually paid. If you get paid a lump sum of holiday comp, that money generally sits where it was paid. It would be used for calculation purposes if it is determined that the payout falls within one of your high earning periods. Also, please be aware that final year, with these earnings now included, would be subject to the 130%, 150%, or IRS compensation limits that we discussed earlier. Members who leave state service and directly transition into retirement may also receive payout of unused sick time left on the books. The payout is a quarter of your entire balance, with a payout maxed at no more than 60 days. Sick time payout is not used for retirement purposes. Let's use an example. Say I have a new retiree named Barbie, who retired July 1st. She had 30 days of vacation paid to her, and her last paycheck was part of her 3 high years. Her last year was calculated using the earnings from July 1st of the previous year up to June 30th, the day before she retired. The additional 30 days of earnings cannot be added to the average salary since the average salary for Barbie's tier is limited to no more than 3 12-month periods. A vacation time differential is needed for the calculation to ensure that the average salary is not overstated by 30 days. The 30-day rate that was in place at the beginning of the 12-month period must be subtracted and then replaced by 30 days at the rate Barbie was earning on June 30th, the last day she worked. The difference between these two get added to the average salary. That is called the replacement mechanism. Doing this calculation provides Barbie with a slightly increased benefit. Now, of course, there are other examples where the vacation adjustment will not apply. Let's talk about Hank. Hank also retired July 1st, but the most recent year of his 3 high years was May 1st of the previous year, ending April 30th of the year he retired. He's also getting 30 days of vacation time paid to him. Because he's retiring July 1st, the vacation time would be used to extend his service from June 30th forward by an additional 30 days. However, since we've already established that he has a higher year earlier in his career, which ended April 30th, adding this vacation time to go beyond June 30th wouldn't change the highest dates of calculation already established for his average salary. Therefore, Hank's average salary would not increase. In summary, the vacation payout adjustment only applies if a member's last paycheck is in the average salary calculation. The adjustment is designed to resolve any conflict between using no more than 3 or 5 years for average salary and using earnings that also represent service credit. This is also reflective of what the average salary would have been if the member worked the equivalent number of days past the retirement date and then retired. It calculates the difference between the total vacation payout at the rate of pay earned on the last day of employment and subtracts out the difference for the same number of days paid at the rate the member was earning at the beginning of that 12-month period. This concludes our presentation on the calculation of average salary. We hope you found this presentation helpful. Feel free to refer to our other instructional videos for information on other retirement topics whenever you have questions on the retirement process and benefit calculations.